Welcome to another edition of Selling Life Annuities. I'm Tim Luby. I'm the National Sales Director with Gordon Marketing on the Annuity Team. And with me today is Steve Allison, our Internal Annuity Specialist on the Gordon Marketing Annuity Team. Today we're going to be talking to you about winning growth solutions in the Fixed Indexed Annuity Market. And what we want to talk about today is, first let's talk about what we mean by growth solutions in the Fixed Indexed Annuity Market. So, when we do case design, how do we differentiate that from some of the other solutions that we offer?
Yeah, sure. So it really comes down to what the client's goals are with their money. And in this situation, they're interested more in growth and accumulation rather than turning on income in the near future or whatnot. So most of these fixed index annuities don't have any income riders built into the product to potentially drag or weigh down the potential for growth. So that's one thing right there. Another one would be just having a finite term. So they're going to have a 10-year product or a 5-year product or something like that. So where they're going to focus on that period of time for growth.
Okay. So the surrender charge period and the primary objective is growth versus income or something else.
Correct.
And of course, annuities all offer income, so annuity would be available from that. But the primary objectives for this are growth. That's what we're saying here.
Yep.
Right. All right. So what are the features or benefits that we find in these growth solutions that make them so appropriate for clients in retirement?
Right. The first one would be definitely bonuses. Some of them have bonuses that are built right in for the premium. So a lot of people may use that for covering some market loss that they've experienced over the recent years, or maybe the money's currently in another annuity product with a surrender charge. So those would be a couple of reasons there. We're seeing.
Yeah, we just talked about bonuses recently in the Selling Life and Annuity episode. Bonuses is a big part of the growth market, and there are multiple bonus opportunities out there. And you're right, one of the best opportunities for those people that are down in their value, in terms of what they're using to purchase the annuity, or perhaps they're going to be down if they take on a surrender charge. So great opportunity there. Yep. What else do we see as some of the benefits? What else are you seeing as some of the benefits that these offer?
Well, they have different crediting strategies. One of the ones that we use often are caps. We're seeing caps as high as 10% or more when it comes to
an outstanding caps. And caps have been around for a long time. I have to believe they're the oldest crediting strategy that's been available on fixed indexed annuities. Yeah. And we still offer them, and I haven't seen them at these levels in a very long time. It wasn't that long ago at all that a 3 or 4% was a very good cap.
Yeah, now
we're seeing a lot now at 10, even better than 10.
Yep.
And that's on the S&P for just 1 year. Not to mention some of the other ones. So caps is one of the crediting strategies. What else are we seeing?
There's obviously uncapped strategies. So like participation rates or spreads, they get a certain percentage of how that index performs. So as simple as 200% participation rate, the index does 10%, you're going to get a 20% interest to credit to your account. Spreads can cut into that growth, but it's uncapped ultimately.
Right, which is interesting. Caps at 10%. When caps were down at 3 or 4, they were sort of seen as almost as like a derogatory thing. No one wanted to be capped or limited. Yeah. When caps are at 10, they're not quite seen that same way. But an uncapped strategy is still going to be preferable in the right environment, right? Yeah. To give you the ability to put up some really big double-digit numbers. Yep. Right. So, which is kind of interesting. So let's stick with the strategies that are available. And so what else are we seeing? We're seeing caps. We're seeing uncapped strategies such as participation rates and spreads. What else are we seeing?
Well, we're seeing some uncapped strategies, but you can have basically like a buy-up rider. You can pay a fee to get a higher participation rate, which you can really bump up your potential for growth.
Okay, so that's interesting. You pay a fee. Mm-hmm. So what's the downside to that? Clearly you pay a fee, you get a higher interest rate, but what's the downside?
Yeah, so a lot of times you hear about the zero's the hero. In this situation, you could actually have a negative interest credit to the account because of that rider fee to have a higher potential for growth. So that kind of goes away, that zero for hero idea.
So if for some reason the index doesn't perform and it does 0, you still have to pay the fee. So if the fee is typically 1.25%, 1.5%, something in that range?
In that range, yeah.
Right. So you could be down by that. So you're still not going to be down due to market losses, but you could be down by the amount of the fee if the index does not perform.
Correct.
Okay, which changes the zero is the hero
Yep.
thing. Okay, I see. So what else are we seeing? Fixed rates?
Yep, fixed rates, we are seeing those. Those have come up a little bit too over the year or so. We're seeing some, 3.5%, 4.5%. We've even seen some up as high as close to 6%. So someone can be a little bit more conservative, but part of their allocation in that to where they can at least guarantee themselves some type of growth.
Right. So any other features or benefits that really come into why people are buying these? What's helping them choose the best growth solution for what they're after?
Well, a lot of times they still want to have some type of liquidity options, some availability to be able to access the funds. And then the common ones are some waiver wires, like having a long-term care waiver or a terminal illness waiver where they can still get access to their funds if something tragic happens or just life happens in general.
Right. Right. So the living benefits, free withdrawal waiver riders. I think it's interesting. We should talk about when we're talking about fixed index annuities, we have this conversation all the time that the one thing, we have two fixed index annuities. They both have a 10-year surrender charge. They both offer 10% free withdrawals. And one showing the account value illustrated at double in 10 years. Another showing it up, just a little over double.
Right.
And what I often say is those are kind of a tie. Because the one thing we know about both of those is that neither one is going to work out the way that it's illustrated, right?
No, they certainly won't. So, managing your client's expectations
That's right.
on how these illustrations show is going to be very important. We've even started to see some carriers come out with adding an extra graph, basically, or chart to their illustration showing what they, maybe a controlled or a flat rate to kind of show that this probably won't happen at the higher rates that we're illustrating. This is a more of a realistic idea.
Yeah, a more conservative set of assumptions, if you will, right? To go along with that idea that if we're showing people, 3 and 4 times the illustrated value in just 10 years, you really want to manage their expectations that could happen, but it's not that likely. And so additional set of more conservative numbers can be a good thing to temper the enthusiasm and to help that client and the advisor better manage their client's expectations about what's really going to happen with that.
For sure.
Right. Good. So, one of the things about this is we're all in this business to make money in one way or another. But what's a typical commission for these products that we're seeing?
So they can range based on the length of the product. So if you're doing a 5-year, they can be 2.5 to 4.5. We even actually do have one carrier that's all the way up to 7 for a street.
On a 5-year product.
On a 5-year,
which is very well positioned.
Right. In most cases, a 10-year will be somewhere around 6, 7, maybe 8, up to 8. So the 5-year product is pretty incredible to be able to get to 7. Usually it's a lot less than that, 2.5 to 4.5. So, those are some things also to consider.
So there's an opportunity there. When you think about the average annuity sale these days being, north of 100,000, I want to say it's close to 120. I know that's close to what our average is.
Yeah.
And then you think about, 120% at an average commission of, 5 on the low end or whatever the number was, to 7 is a very typical commission level. That's pretty good. I mean, we're talking, $8,000-9,000 in commissions on a standard case, on an average case. So that's, another reason why it would make sense to do this. And so for the benefit of those watching this video, how do they reach us? Your email address is?
Yeah, sallison@gordonmarketing.com.
And your extension is?
Yep, my extension is 140.
Okay. And I'm Tim L at gordonmarketing.com, and I'm available at extension 213 at gordonmarketing.com. So we're kind of running out of time. So one last thing, I guess, is if you're watching this, if you would please subscribe below and click the notification bell so that you'll be notified when we come out with new episodes of Selling Life and Annuities. And with that, we'll bring this to the close. Thank you so much for joining Steven and I on our winning growth solutions in the fixed indexed annuity market, and happy selling.